Hey guys, again, welcome to the Mills Social Talk. This is Leroy Viamel at Mills Realty, Managing Broker, CEO. And today we have with us Mr.
Peter Streff from Guaranteed Rate Mortgage.
Peter is a good friend of mine. I've been doing Peter for a long time. And Peter has been in the business for a long time. I'm doing a lot of deals. We've worked together quite a bit. And Peter from Guaranteed Rate. So we want to be able to let you know that Peter will bring about 30 years of experience to the business. So if you're out there and you want to know something, connect with us at millsreal.com, go to the Mills Social, send us a message, and we will be able to connect with you and Peter and Mills Realty. Also, Mills Realty at this point is hiring, so we're looking for agents. If you're looking to grow your business with Mills Realty, let us know. We're willing to hire and train and keep you informed of what's going on in the industry today. Also, thank you for listening to the podcast. We want you to continue to listen to our podcast. We'll be bringing you the best of the best. We'll be bringing you people with experience, who knows the business, who knows what's going on, and you can get some insight from us. And if there's something you want to know, please let us know. Please share. Please let us know what you want to know, what you want to talk about, and we will bring you those individuals in order to help you educate yourself in the real estate industry. Again, Leroy here. So Peter, thanks for coming in, Peter.
Sure.
I want to tap on two things with Peter. Peter is great at residential, but he also has a lot of commercial experience. So we'll get some knowledge on how you go about, because I know there's some of you out there who would like to buy investment property, but not sure exactly how to go about that. Peter will give us the nitty-gritty on how to do that and what we need to do, how we need to handle our finance and all that good stuff. But before we get to commercial, I want to start out with residential. And so Peter, tell me a little about what's been happening with you in the market, what's been going on, what's going on with rates, and everything else. Just generally, what can you tell us about what's happening in today's market?
Well, the sales market's very strong. There's still a limited supply of properties available, so that's driving the prices up. With respect to interest rates, they're kind of creeping up. The Fed has said they were going to keep them at bay, but they're slowly rising. So they're out of the 2s and into the low 3s at the moment. And as far as interest rates, I think if you're out looking now, you would lock your rate. If you're out shopping around, I would lock it. I wouldn't take any chances on rates continuing to drop. I think they're on the upside of interest rate world. What else? As far as lending goes, we're as a company are still lending with as little as 3% down for conventional financing. And another game in town, like everybody else, FHA with 3.5% down with less than perfect credit borrowers. Is working well.
Where are we at with FHA? I mean, when you say less than perfect credit, what are we talking about?
Well, when it's less than perfect credit, as a loan originator, I am looking for credit scores. Typically for a conventional loan, it's 700 or above to qualify for some of those 3% down programs. FHA will go down to as little as 620. And the good thing about FHA lending, they won't raise the rate, if I may say it, when it has a low credit score versus a conventional loan. The rates will be higher when they're below 700.
Okay, however, most people, of course, a lot of us are not at 700. A lot of people are not at 700.
Correct.
So a lot of people, you prefer to go to the FHA rates, which is 620, 620 and above. What's the difference in rate from a 700 to a 620, or a 740 to a 620? What do you normally see the difference in rate would be?
Well, if we're talking conventional, the pricing will be totally higher for a borrower. It would probably be near 4% versus an FHA loan would still be in the high 2s or low 3s. So that's why I would use FHA financing for a credit score that's maybe 680 and under. When you're in the 700 or above 720 for a conventional loan, you're going to be in the low 3s. So it's a big difference, really, when it comes to the interest rate. FHA doesn't discriminate upon that on a credit score
Okay.
as much as a conventional loan would. So
So you would advise so are you is guarantee rate pushing FHA, or are you just kind of, because of course the rates are so low, or it really depends on the client?
it always depends on the footprint of the client and how I will determine which program I will use for him or her. I'm just saying that when I do pull a credit, when we do a pre-qual and I see that the credit is damaged, if we can't improve upon it, and we can get by with what it is right now, currently, then we might do an FHA loan. If the credit isn't hindered and the scores are acceptable, then yes, we're going to go for a conventional loan. And I'm always going to do what's best for the client.
Correct.
So,
and talk a little about, and this is inside the FHA loan, and so folks can understand what the PMI is.
well, on an FHA loan, there's government has, upfront mortgage insurance premium to insure the loan in the event of default, and the consumer will pay for that upfront mortgage insurance premium, or PMI, for the life of the loan.
That's called private mortgage insurance.
Well, it's kind of not the actual language of it, but in the acronym of it, yes. And that basically is dependent upon the down payment, which would be a certain percentage for the consumer. On a conventional loan, if the credit score is pretty good, after a few years, the PMI will fall off the loan. So, which is kind of nice. Anywhere from 3 to 5 years, it has the ability to go away.
Okay. And the PMI, of course, I think what we should explain, or maybe you can explain, is some people say they assume, a lot of folks assume, that FHA is actually the lender.
That's true.
That's a
true.
really misconception.
And there's a lot of misconception out there that we need certain FHA appraisers. I mean, there's a lot of misconception on FHA, and there's certain repairs, a lot of things to be done. So each individual case is definitely different. I got the sidetracked. The federal government just insures the loan.
Right. So
in the event of default, I hate to say, the taxpayers will be footing the bill.
So the FHA,
but the loans are coming from Wall Street. In my world, it's called Ginnie Mae. You might have heard the terminology Fannie Mae or Freddie Mac. All of us lenders adhere to those certain footprint guidelines that are set forth by Ginnie Mae or FHA, Fannie Mae and Freddie Mac. So there's a certain little box we fit into. When it's outside the box, then we may have to go to alternative lending, which is out there as well.
Yep, I do want to get to that, but I want to be clear for those of you, and this is a huge misconception. FHA does not give you the loan. FHA is the insurer. It's more of an insurance in case the loan gets default. Because people say, I want to go FHA and they'll give me a loan, but I know that for a fact, because it comes to me all the time. Can I borrow from FHA? No, FHA is not a lending entity to say, here's the money.
That is correct.
They're insured just in case you default. We, the taxpayer, pick it up.
Yes. Yeah. I don't want to be that's true. Right now, every loan that we originate as a company, though, dot the I's, cross the T's. It has to fit into that little box. And it's, things are working well.
And so we're going to continue talking FHA with Peter. Peter, I wanted to, from Guarantee Rate. Again, this is Leroy at Mills Realty. Thanks for tuning into to the podcast. I want to talk a little bit about the 203K program, because I try to push that program for people who want something that it could be that they want a home, but the home doesn't have a kitchen, doesn't have a bathroom, but it's a great home, the size fits, but tell us how that program works. And I think let's talk about both sides of this program, whereas the 35,000 is streamlined, and what I call the full-blown FHA program, where it's an $80,000 repair. Let's talk a little bit about into that.
All right, I'll briefly overview. Will be when the client wants to buy a home that maybe needs a kitchen upgrade, new bathrooms, yes, we can lend, it's called the 203K loan, acronym for, the consumer. It'll allow for renovation. So let's just assume that the house is at a certain price of 300 grand and the borrower wants $50,000 or 35,000 to fix it up. We will add the two numbers to determine that full purchase price. And we will require the minimum down payment on that total purchase price and rehab, which would be 3.5% down, and guaranteed rate will fund the renovation. So the customer can get a new kitchen, a new bath while they're buying the house, when they close on the house.
But we got to make note that the
Work needs to be
purchase,
done.
work needs to be done, and the purchase and the renovation has to equal to the full appraised value.
That is correct.
All right, so
And the work
that's
needs to
important.
be done by a contractor. No,
Not a licensed contract, not your uncle.
not your uncle. Yes, sir. Yeah.
That's
Everything's
right.
by the book,
Yeah.
but they move smoothly, anywhere from 45 to 60 days through the process. The biggest thing is getting the work from a contractor to specifically spell out everything that he or she is going to do for that homeowner.
Correct.
Get that done properly.
Now, there's two sides to, and just want to, there's two sides to the FHA program. Let's talk a little about
They
there's a
call it a
streamline,
streamline. It
right?
basically is less paperwork, but either program, I'm still may need a FHA HUD inspector
Right.
to determine that the work that needs to be performed will meet FHA guidelines. Okay, like you and I would walk into a house and might not notice that certain items need to be addressed to be acceptable for HUD. So this gentleman will come in and inspect the property with the contractor, and they'll go over the work that needs to be performed. And they'll determine that everything is either okay or maybe add more to it.
However, the contractor, that if you're going to spend less than $35,000 is a little bit maybe less stringent, you'd say, or than someone to spend $100,000.
Yes, okay, I'll go along with that. Okay. Any loan that I do, though, I'm gonna review all work to be performed. It's gotta make sense. It's gotta look right, and be acceptable to not only guaranteed rate and the appraisal department. So there's a process.
It's a process.
But it's being done, and it can be done. Yes.
Yeah, but what I'm trying to say is basically when you're spending $100,000 on a repair, of course, I mean, you have that consultant there with you right through the end, correct?
Correct.
And so you have to understand that when you're doing that, that consultant moves through you the process, through the draw, but you have someone behind you looking after the work to make sure that that $100,000 that you actually borrow from guarantee rate is spent wisely.
Correct.
All right.
Yeah. In simple terms.
In simple terms, right.
Yeah.
But you got to remember that, you can't, it's still got to make sense.
I'm not dumping in to put in a new pool or a workout room.
Right. Yeah. You got to be, kitchen, bathroom, windows, plumbing, electrical,
right.
Stuff that makes sense.
Right.
So tell me a little about, as we move off of FHA, a little bit about what's the alternative lending? Tell me, because you mentioned that.
Well, I mentioned that there's some lenders that are opening up their doors to do loans that may not fit into the so-called Fannie Mae and Freddie Mac world. I'll just say the little box, and some of these other lenders will look at them now, and maybe with more money down, maybe damaged credit, they might take a shot at it. There might be a requirement of 25% down or 20% down, but depends on the structure of the deal and the borrower, and there's so many other variables, but it's out there. It's coming out there now. It's starting to open up with COVID coming about last year. Everybody shut down.
Okay, so
all of those programs went by the wayside, and it was just strictly loans were being originated at my company, Fannie and Freddie and Ginnie Mae, FHA. That was it. Now the doors are starting to open up. Some of the lenders are emailing us a little bit more liberal guidelines. And every case is going to be a different. So I can't specifically spell out a case. I'm just saying it's out there.
And we're looking at, So they're doing portfolio.
Portfolio programs in the consumer world, you would call it a stated income loan.
Oh,
Okay.
are those coming back?
So some of those lenders are coming back with it. The rates are, may not be as attractive, of
Right.
course, but down payment, decent credit, they grade it and then they'll tell me they have an interest or not.
Now, I want years ago,
Yeah.
when before these programs go, I'm gonna say we'll date ourselves, been in the business 2004 or
Long
5,
time
say
ago, years ago.
years
before
ago. I mean, there's a lot of stated income program, right?
There was a lot.
And so is it being structured the same way? I remember you could have said, hey, I made $90,000 and they just kind of roll with the program. That's 2000.
2000, yes. The
Yeah,
early
yeah.
2000s.
Early 2000s,
It's
right?
no, it's not like that
So,
anymore,
yeah.
but it's potentially out there.
Okay, so
But
and this is interesting because where are your guidelines, or have they sent you guidelines to say we are doing state income program, we'll need X, Y, and Z, not going back to early 2000, but to say, you know what, you could have gotten rid of a lot of stuff early 2000. Where are they now?
The basic,
where are the basics now?
Is we want a 700 credit score and they want 25% down on an owner occupied property. The pricing on that today was a 5.5% on a 5-year loan.
Oh, okay. So
it's not bad. 30-year amortization. So that's just a barometer, but it's a starting point for this customer.
Okay.
So, and no, I don't have any defined. It's just I kind of look at the whole file and then I determine, all right, we're going to send it off.
Okay. So question, because it's a question here.
Yeah.
So, for example, I'm asking you an example because I'm thinking of something in my head.
Okay.
I have a client, lost his job through COVID, getting back into the work field, has the 25% down, has other investment. Will he or she, maybe not currently working now, but anticipate his job back to his company? But today, his income is coming from his investments. All right. So, I mean, just give me a barometer. Would that work? Or is that something
He's not back at work?
Not back yet at work, but
those investments are providing his revenue stream.
Revenue stream for now.
Depends if he's
with great credit, 750.
The down payment's there, the credit's good. It's something we can look at. There's no promises, but it's definitely can be looked at.
But do you foresee that? I mean, do you foresee that's a possibility, being the fact that that client is not back to work as yet?
I give everybody the benefit of the doubt, bro. The benefit of the doubt. Peter Streff never says no until I try all exhaustive resources. So it's every deal's worth looking at, trying to help somebody out get to the door.
Okay, so
I wouldn't say no to anything until I formulate and review the whole
package,
whole deal, the whole story. Everybody in this room's got a story. Everybody's got a background. So I treat everybody the same and try to get from A to B. Yes.
All right, cool. And that was just something in my head. Sure. Because a thought came to mind. I'm thinking, that's a possibility. All right. So we've covered the 2 or 3K program, which
we kind of touched on that.
Yeah, we can't. I mean, again, for more details, you can go to the Mill Social or email us at millsreal.com. We'll connect with Peter. Peter, what's the number they can get a hold of you? Just in the mail. What's the number?
Sure. 312-415-0884.
All right. And as we continue, you can talk, as we continue, we'll continue to do this. Now, let me ask you, Peter, I want to talk to you about commercial, because you're big on commercial.
Correct.
Tell me a little bit about how people qualify for commercial. I mean, because there's people out there who wants to buy commercial, but don't think that they can. Tell me a little about commercial property and what you see happening today in commercial. And we'll talk about first residential, then let's drop down to like mixed use, and then we can talk a little bit larger investment. So let's talk first.
Okay, the nuts and bolts.
On the residential,
commercial loan or investment loan in the residential world. for my investors, we need 25% down. I'm looking at the asset, the
Mhm.
subject property, and its ability to repay the debt, the rental income. So if the rental income's there to support the loan request, it's very
That's right,
strong
yeah.
possibility of an approval for a conventional 30-year fixed rate, single family, 2 to 4 unit type investment. Then when we get outside that box and we're in the 5 units and above, storefronts with apartments, we're also looking at the income, not only of the subject property, but of the borrower. They call it secondary income. The
Okay.
borrower's secondary income. He or she might be an accountant making $100,000 a year, so they're pretty stable.
Mhm.
That's a nice revenue stream. And then the building has its cash flow to pay the mortgage too. So we're looking at that, whether or not it has positive cash flow or negative cash flow. Every deal has a different footprint again. Every property right now, multifamily properties that are 5 and above, all residential, they all seem to be working okay. It's the retail that's getting hit because a lot of the stores are now being vacated. There's not enough revenue stream to cover
Correct.
the mortgage payment, we'll say. So that's when we go to the principal, the person buying, and see what his or her income's like. Can they handle the negative cash flow? So if you had a guy making 250 grand a year and the mortgage payment is losing $500 a month, he or she can afford that loss.
Yeah, yeah.
That's just kind of a quick overview of that scenario. But banks are lending on commercial. Yes, they are.
Well, one thing I wanted to, I want you to talk about, because I think we had gone through this before. There's a new borrower, never done commercial before, but want to buy a commercial. How would the bank look at that particular person? Got some money, hey, I want a 10 unit. I got the money, but I've never been in this situation of borrowing before, or I don't know never how to manage a 10 unit. How would the bank look at that?
Again, that'll be on a case by case.
Mhm.
We closed a loan a year ago, not you, but with another client. And because it was his first investment, the bank requested a full management company for the first year for the transition from a new buyer to, him, so that he could kind of work together.
Right,
And
right.
after a year, everybody was happy and things moved along fine. He managed the property. So it depends again on the whole.
On the whole,
Everything.
whole suit.
We're all putting it all together. Yes.
on a commercial side, will the bank, or does the bank, or can the borrower get a gift for commercial?
Yes.
And what position he would have to be in to say, to get a gift? I mean, what if the property is not being, is not bringing enough money? Can the bank say, well, hey, you can come through with John Merritt cosign, or you could, get a gift for $50,000? How would the bank handle that if the actual borrower is not bringing in enough money, or the property is not bringing enough money? Is that a kind of a
problem?
Kind of a problem?
Yes, it's a problem, but the way around that scenario is a possibility. If the gentleman's got cash or customer, maybe we deposit with the bank.
You mean have an account with the bank?
Have an account with the bank.
Okay.
A year's worth of mortgage payments until they stabilize the property.
Okay.
So
Okay.
I won't know until, again, I see the borrower's background, revenue stream, business plan. So there's a few components there that we'd have to
Get
hammer
so
out.
there's nothing real. I mean, when it comes to commercial, you don't have a
commercial loan. It's not a defined method
okay.
like it is on a residential loan. You either fit in the box or you don't. Right?
Okay.
Certain amount of income to pay that mortgage, certain amount of income to pay the mortgage and the monthly payments with car loans and student loans, etc. On a commercial deal, I call it more common sense underwriting. Okay. And that's why we need to have the whole story of the client. Okay. His or her business plan. What's their background? How long have maybe they have owned something, maybe they haven't, and they're trying to dive in. So they might have a business plan.
Okay. Gotcha.
So
So, but just so folks know that sometimes, and just kind of clarify this in that if you're looking at a commercial property and on your own, you don't qualify, but that commercial property is bringing in X amount of dollars, that X amount of dollars would help you qualify for that particular property, if that, especially that can carry its own debt service, right? If that loan,
That's a general, rule, yeah.
right? If you can carry it, then you're looking at, yeah, we can do this loan because of the fact that the mortgage on this particular property may be $1,500, but it's bringing in 25 or 2,800 bucks a month, so
Correct.
so it's easier to qualify.
Good, makes the bank a little bit more comfortable. Yes.
Right.
Yes.
More comfortable than to do that loan.
Yes.
So have you give me an example of something you've run into that maybe this is your experience, and you've been doing this for a long time, that you've gotten someone through, but it was like pulling teeth, but you got it done. I just want people to know that you're good at what you do.
Every deal is pulling teeth. Every loan is pulling teeth. But no, on the commercial side.
Yeah, on the commercial side.
I mean, I have a loan pending right now down in Taylor Street, hot neighborhood, right? 1100 Taylor Street area. And in order to finance it, because there's a current restaurant in there shuttered by COVID, but 2 apartments and a strong borrower. In order to do that loan, I asked the borrower to put up a year's worth of mortgage payments until he stabilizes that building, and we're moving along.
So the borrower puts up the money, so the bank knows that they got a year to go.
They got a year to go to stabilize.
To stabilize.
Hopefully, we better be out of this COVID by a year from now.
Well, hopefully, less than a year from now.
It better be by July. I gotta blow off firecrackers.
So let's talk a little bit different commercial.
Okay.
A little bit different, and someone wants to buy a community center, a church. I mean, that's a different ball game. That's a ball game of itself.
In itself, it's definitely a little tougher.
Okay.
Definitely, it's not something we can totally formulate here. It's
yeah, but
really
give me an
takes a
overview. Yeah, I mean, because I'm sure for the folks who are listening, and if you're looking to buy a church or some kind of storefront or whatever you're trying to buy, I mean, we at Mills Realty and Peter can get this done for you, but it's a little bit more complicated. I'm going to say it's not a 1, 2, 3.
Yeah, we got to have a history of that revenue stream for at least a few years, so I know we have a track record of that person or persons that are purchasing the property. So
a track record of that person, that he or she had the experience to do that.
Correct. Yeah.
Okay.
Experience. I mean, I do a lot of commercial condos that you see throughout the Chicagoland area. Those are on the first floor of a 3-flat storefronts, and people that are buying those are going to be owner occupied. They're chiropractors,
they can,
physical therapists, psychologists, catering outfits. So they have a history.
Right. They have a history of,
and they're paying
someplace
rent
else.
Maybe.
Okay.
And they figure, hey, I can go in and buy this commercial condo and set up my shop, and I have the same mortgage payment and I'm paying in rent. So those are making sense, and those loans are being approved.
So, but the bank, I mean, the bank right now, I mean, knowing that we have a lot of vacancy, and I was just looking at the financial report and knowing that I'm going to say New York has quite a bit of vacancy, and they're hoping that all that comes back. I mean, the bank is still not shying away. I mean, there was like I don't know, it's 10% vacancy or whatever it is. Even in Chicago, there's a lot of vacancy because of COVID. The bank at this time is not shying away from lending money from commercial to qualified people. They're not like trying to be. They're not trying to be more stringent, are they?
They're stringent on retail because retail is getting impacted right now. Retail, mom and pop nail salons or neighborhood coffee shops, they're getting hurt.
You mean the bank is?
So the bank may scrutinize my loan. Yes.
Okay, a little bit more tougher on those loans.
Tougher on those deals. When I had said to you earlier that the commercial loan that are very strong for me is the owner occupied. He's going to have his chiropractic shop there, his real estate firm, maybe a doctor, and they're going to
Okay.
open up that space, psychiatrists. So those are moving along well. But if you had a retail place in California and it was all storefronts, that would be scrutinized a little bit more. We want a stronger borrower with good reserves, carry the property, don't know about the tenant profile, how long the leases are, a lot of things. And that's why I say each deal is different.
different.
Each deal is different.
And but by the way, do you do jumbo loans?
Yeah, we do jumbo
And
loans.
they're how's the market on the jumbo loan? And just explain what jumbo loan is, so the listener out there knows. I mean, I'm sure we have some listeners that can spend that kind of money. So, and Peter Streff is the right person, right? Peter Streff along with Mills Realty.
Yeah.
Well, hey, we'll get it done. So tell me a little about jumbo loans. And you know, we're just doing mostly commercial.
The only thing on a jumbo loan is it's anything above $548,250 loan.
Okay.
Everything's the same. We got to dot all the I's, cross all the T's.
Rates are the same or no?
Well, rates are a little bit higher. Instead of being, I looked at one yesterday, instead of on a 15-year loan, 2.5%. And then on a jumbo, it was 3%. So
Okay,
about a 50
okay.
base, 50,
Yeah,
half a point higher in the rate. But jumbo lenders that we had to work with want strong credit. It's got to be above 700 or it's not going to happen.
Right. Okay.
Good reserves,
Okay.
typically 12 months worth of the mortgage payment, liquid after the loan closes. Not only your down payment of 10%, then you have to have a year's worth of mortgage payments sitting in the bank.
Sitting, okay, so on the
Somewhere.
jumbo.
Yeah, on a jumbo.
Jumbo, you
Gotta
gotta have
be
a
liquid,
year
yeah.
worth sitting somewhere.
Correct.
Okay.
So that sometimes can bite somebody, but that's
Yeah,
what's
because
required. But the underwriting processes are the same. You're gonna have to qualify a certain amount of income to pay the mortgage payment.
just explain the terms, because I think people think when it comes to the commercial, it's not a full 25-year armor. It's like a 525, correct? Or so
All right, bouncing back.
it's bouncing back to
you
the.
went- you
I
from
went back.
jumbo,
Back.
Now we're back to commercial.
back to
So the
commercial because
commercial lending.
Yeah, back to
Okay,
commercial
the
lending.
programs that we typically do is a 5-year loan. It's amortized over 25 years to come up with the payment.
Mhm.
And at the end of that 5-year term, it becomes an adjustable rate mortgage for the next 5 years. So your rate will change in years number 6, 7, 8, 9, and 10. And then basically at the end of a total of 10 years, the bank will readjust at whatever rates are down the road. Recast it, we call it.
So you can't.
But we're together. We could be together for 10 years.
But with the bank, are you looking at back to commercials? We're talking just the commercial loan, and that's a 5+ loan. And is that based on the 5-unit up, or are we talking all commercial, mixed use, and everything?
Yeah, anything outside the 4
unit
residential world is considered for me a commercial loan.
So
Anything, and they're all 5-year loans, 25-year amortization.
all right,
Every one. Storefronts, Six Flats, shopping centers, strip malls, whatever. Churches.
So we're talking. So other than that, so it's a 525. I want to just kind of clear something up for those. And by the way, if anyone wants to ask a question, send us a message. Go to the Mill Social, and we'll get back to you with the answer. So please don't be afraid to let us know what you like as we wrap up with Peter Streff from Guarantee Rate. But I want to clarify the 5-year and the 10-year and the 5-year after. It's not an option. It's just that the bank just gives you another 5 years to change rates. The rates may go up and down every year. So
Yeah, the relationship.
yeah.
You're with the bank for a fixed
Fixed-
rate
for
for
fixed
5
fi-
years.
Right.
And then you could stay with the bank in years 6, 7, 8, 9, and 10, but the rate will adjust, and the rate is going to be determined
Right.
by the 1-year treasury, and then they add a margin.
But
to
do
that
the bank
index.
after 10, if you stay with your bank,
For
do the
10
bank
years.
then just do a refi total
Well, in 10 years.
in
you
10
mean?
years?
Yeah.
They'll just do it and
Yeah,
then
assuming you
adjust.
pay your bills and everything's good and the property's still fine. Yeah.
They automatically do a refi.
Right. They'll do a refinance at whatever the rates are down the road.
Gotcha. All right. So, hey guys, this has been a great commercial topic. Again, this is Leroy at Mills Realty, along with Peter from Guarantee Rate. You can check us out at the Mills Social, Follow us on our podcast. Thank you for listening.
Yeah.
Go to millsreal.com, and you'll find all of this information. Peter, where can I get a hold of you?
Peter Streff, 312-415-0884.
All right, so
thank you.
And keep in mind, if you're looking for a career with Mills Realty, we are here to help you grow your business. Or if you want to get into the business, we're here to guide you through that. So I want to say thanks again for listening, and we'll see you on the next show. Thanks, guys. And again, this is Mills Realty and Peter Streff from Guarantee Rate. Thank you.